Hello everyone and welcome to Some More Fun with Fitzy. We are starting Chapter 9, which is completing the accounting cycle. So this video is going to be 9.1 Part 1. The adjusting process. So financial statements, as you know, are used to assist accountants in making business decisions, as we did in Chapter 8. It is the accountant's responsibility to ensure that these financial statements are accurate, up to date, and consistent from year to year. What we haven't talked about right now is some of the accounts are not up to date. Therefore, they're not accurate. When preparing the financial statements, the accountant must ensure all accounts are brought up to date, all late transactions are taken into account, and all calculations have been made correctly, and finally all gaps and now IFRS have been complied with. Bringing the accounts up to date at statement time is known as adjusting. So actually the accounting entries or the journal entries produced by doing these adjustments are known as the adjusting entries. So if you hear me say, I need you to do an adjustment, or what is the adjusting entry? It's the journal entry that you need to put in the journal as a result of doing these adjustments. Basically what happens is these adjusting entries assign revenue or expenses to the correct accounting period before you prepare the financial statements at the end of each fiscal period. The adjusting process is necessary because accounts are allowed to become inaccurate between statement dates. For example, when you buy supplies, you debit supplies and credit cash. And then slowly but surely over the month, you start using up those supplies, and the supplies start going down. However, you've not done anything to your supplies accounts. You may have used the entire supply cabinet right up and your supplies still might say $100, but that's inaccurate. So some accounts do not need to be perfectly accurate at the end of each business day. However, they do need to be adjusted at the end of the fiscal period in order to determine the correct net income or the net loss for the period. Okay, so here are some examples of adjustments that we're going to be doing. Supplies, prepaid expenses, and we'll talk about them when we get to them. Late arriving purchase invoices, and there's also depreciation, but we're going to save that till the end of the chapter. So by now you should be able to explain what adjusting entries are, or what adjustments are, and explain why they're important. In the next 3 videos we're going to do supplies, prepaid expenses, and late arriving bills. Stay tuned for more fun with Fitzy.